Apple reported yet another record earnings on April 28 after hours. But what price should we buy Apple? Let's talk about that. This is the earnings snapshot from the earnings report. They reported a quarterly revenue of 97.278 billion and an EPS of 1.52. Not only did they beat the base expectations, which were the revenues and EPS they reported last year of the same quarter, of 89.584 billion and 1.4 EPS, they also beat analysts' expectations of 94.034 billion and 1.42 EPS. I guess last year's revenue was not a blip at all. They continue growing their revenues. I'm actually impressed by their numbers. Their revenues grew 9% year over year, net income grew 6%, and free cash flow grew 18% year over year. Although their net income margins fell slightly from 26.38 down to 25.71, while their free cash flow margins grew from 24.24 up to 26.37. These margins are important because this is what we're paying for in Apple stock. Not the revenues, not the rate of growth, but their margins and their reported EPS. Previous EPS trailing 12 months was 6.04. Now it's 6.14. That's 1.66% growth in EPS. If you ask me, this EPS growth is not by much in the sense of net income growth versus them buying back shares. This quarter that, would fuel a rally after they reported earnings. In fact, if we look at their charts in pre-market Apple, stock opened at 161.84, lower than previous close of 163.64. Also in their report, they announced an increase in dividends, 5% increase from $0.22 per share now to $0.23 per share. They also announced $90 billion worth of share buyback. Overall, this earnings snapshot is just incredible for the company and the stock. Now, what prices should we buy Apple? If we go back to our 5-metric summary, I have fair values for Apple stock of 137, up around $2, $3 from around $134 to $135 from previous quarter's fair value. I still use 22.31 here as their margins. This is their lowest margin, the 5-year average net income margins. Why do I still use this? Why not use the current margins of 25 and 26 margins? Again, we buy stocks at their weakest, not their strongest. Although, my entry PEs here are 18, 20, and 22. That is 30% margin of safety discounted from their highest margin, 26.37. Look, 26.37 times 0.03 minus 26.37. Yep, 18. Then from there, increments of 2, 18, 20, 22. This is updated already. From their recent quarter report, Apple stock is now down 14.31% of the highs. First metric, EPS multiple is still high at 4.4. This is the PE divided by the EPS. This metric is what I usually use when I'm screening multiple stocks. This metric asks us to understand either why it trades at a high PE or why the EPS is too low. EPS is healthy as seen here. It's increasing slowly. That means the PE is too high. OSN here is number of shares. This is good too. They're buying back shares. Second metric, we want to pay $1 or less for 1% of the money they're making. Meaning, we want to pay 1 PE or less for 1% of their margins. This is based on the lowest margins between the net income and free cash flow margins of the previous or current year, trailing 12 months, and the 5 and 10-year average margins. I used 22.31 here to divide the current PE of 25.48, and we'd get a premium of 1.14, meaning we're paying Apple this much multiple for maybe growth. After all, Apple is a growth stock. Third metric is price to free cash flow. I want this below 20. If it's above 20, and it is, I'm not a buyer of the stock based on this particular metric here. Ultimately, we want to pay a lesser PE than the price to free cash flow. At 1.06, we're paying premium for the stock. Fourth metric is designed for stocks that pay dividends. I discount the dividends paid to investors from their free cash flow because they can't really use the same money they pay to investors to buy back shares. This just gives me an idea of their free cash flow margins once the dividends are discounted. In this case, it's 23.62, meaning we might want to buy Apple below these margins. Lastly, last metric is historical PE. We want to know our discount compared to when the markets have valued the stock before, based on their historical PEs. I have here two historical data, one from Guru Focus and the other from Macro Trends. We'll use the average historical PE to divide the current PE and we'd get 1.64. This simply means the stock is trading at a higher PE now compared before. These are the only financial ratios and metrics I look for when reviewing their financials: the cash, long-term debt, PB ratio, and current ratio. PB ratio is so high at 37.64. I want this below 5. This is market cap divided by the total equity. Current ratio is 0.93. We want this above 1. This means their current assets are lower than their current liabilities for this quarter. They're virtually debtless with their strong cash and free cash flow. So yeah, these are my entry PEs and prices for Apple stock. I'm still a buyer of Apple at 135. But for Apple, the biggest tech stock, the most valued tech stock right now, I'm okay paying around at their fair values at 137. There are two ways to buy stocks for the long term. One from fundamentals and the other from their charts. There are certain levels buyers show up, and maybe you want to defend those levels with them as well. In fact, Warren Buffett has been buying the dip for Apple. Last quarter, he bought 600 million worth of shares. This rectangle here is a crucial support for Apple. Once this breaks, maybe we'll get our entry price. 137 is our fair values for Apple. That is with our 30% margin of safety included already. Of course, you always want to buy below fair values to price in your risk and margin of safety. With the Fed's raising rates, revenue growth for all companies might see some headwinds. I'm not itching to buy Apple just yet, although I gotta say, a very strong quarter for Apple. But by these metrics, it's still not a $3 trillion company just yet.